Shalom, everyone. Welcome to another episode with Bot Caleb Consulting. This is your host, Malka. Let's get started. Today, we are going to go over buying assets and equipment for your business. See, your business will need special assets and equipment to succeed. But do you know the difference? All right. Business assets fall into three broad categories. You have tangible, intangible, and intellectual property. Depending on the asset type, you'll have to decide whether you want to buy or lease assets for your business. The first step is figuring out which assets will help your business to succeed. As always, we always start off with a scripture because Yahweh is everything. Luke 14, verses 28 through 30 says, "For which of you intended to build a tower, sit it not down first and count it the cost, whether he have sufficient to finish it. Lest haply, after he had laid the foundation and is not able to finish it, all that behold it begin to mock him, saying, This man began to build and was not able to finish." Now you see where this scripture goes with knowing the type of assets you need for your company and how to protect them. Let's go. Tangible assets, things like buildings, vehicles, and equipment, are used for regular business activity, but they lose value over time. Now, when you talk about printer paper, that gets used up. That's not counted as an asset. Now, the printer is counted as an asset, but the printer paper is not. So, when managing your finances, you can count tangible assets on your balance sheet as property or equipment. What are tangible assets? Tangible business assets are physical items as the company own, like your land, your building, your machinery, vehicles, inventory, raw materials, finished goods, furniture, and office equipment, as well as cash. These assets has physical substance. That's why it's tangible. You can touch them. It can be seen and touched. These are recorded on your balance sheet and often depreciate in value over time, which you can write off on your taxes, directly supporting business operations and revenue generation. That's why it can count as a deduction on your taxes. Seek out the advice of a tax professional for that. Next, intangible asset. That's like Casper the Ghost. Your business reputation, your brand or business partner influential network are intangible assets. Things you can't touch. You don't list these on your balance sheet, and it's often difficult or impossible to sell them for cash, but it can still contribute to the overall value of your business. Intangible business assets, they're non physical items. You're talking about intellectual property, your patents, your copyrights, your trademark, your software, your brand value. You think your brand is valued at $1 billion. Yes, your reputation, that's intangible. Customer loyalty, your brand names, your customer related assets, your list, your customer list, your relationships that you have built with your customers. Those are intangible. You still have to protect them. That's proprietary. You have to protect proprietary knowledge, your know how, your processes. These are all which provide competitive advantages and contribute to your company overall worth in addition to physical items like building or equipment. Those are intangible. The way you treat your customer, intangible. Intellectual property is a type of intangible asset that includes your trademark, patents, logos, websites, domain names, and software. Intellectual property is often protected by copyright or trademark protection. Yes, now when it comes to equipment, you got to decide with these assets, do you want to lease or buy? Leasing can be a good thing. It has benefits. You need less cash or credit up front. Short-term lease lets you test out the equipment. Maintenance is sometimes included at no extra cost. Lease payment for business assets are typically tax deductible, but the disadvantage is the lifetime cost is normally higher than buying. Oh my gosh, like I'm just leasing a warehouse and I'm like, wait a minute, these buildings that I'm leasing, when you look up the yearly cost, it's like I can buy, I can buy I can buy these buildings. But hey, you know what? With a new business, sometimes you have to lease to get that credit up and running. Replacing it when the lease is up could be expenses. Depreciation of lease asset typically isn't tax deductible, but you could seek out advice from a tax professional. If you decide to lease or buy in, you can claim depreciation in your taxes when you buy it. The lifetime cost to buy is usually less than leasing. Buying, you can count it as an asset on your balance sheet. Buying, you can use it for and no matter what happened to it, you're the one that's going to eat the liability because it's yours. It's yours. You can drive the truck as many miles as you want. You don't have a cap. Now, the disadvantage is you need more cash or credit up front, less opportunity to test out the asset, and you could be fully liable for maintenance and replacement. But so what? You got to figure out if you want to buy your assets or lease them. Either way, they're tangible assets. All right, want to know where to invest? Contact us. Want to start your business? Contact us. Want to know more about assets? Like, share, comment, subscribe. Let your friend know. Note in the comments, botcolibconsultant@gmail.com or sign up at botcolibconsultant.com. Praise Yahweh, glory to Yahweh. Like, share, comment, and subscribe. I'm so grateful for those who have subscribed and so grateful for those who find this information helpful and use it to better yourself and your business as a whole. Praise Yahweh. Shalom. Until next time.